Thanks for joining my market report. My name is Mike, and I am a loan officer with the National Lender. So if you guys got questions about this report, about mortgage rates, or if you got questions about refinances or purchases, looking at different options, getting pre-approved, please feel free to reach out. I'll be more than happy to talk to you a little bit and discuss that with you guys further, but feel free to reach out. I'm out. This report is about mortgage rates on a daily basis. They do change and kind of change throughout the day, and a lot of people don't realize the volatility that happens in mortgage rates. So I'd like to present this to you so that way you can kind of gauge as to what's driving mortgage rates on a daily basis. I don't go so much into what the rates are, primarily because that's different for everybody. There's so many variables that go into it, like amount of equity, types of property, occupancy. Credit scores, all those different factors that kind of go into it, and it's different for each person. So there's no one size that fits all, and different loan programs as well. So without further ado, let's go ahead and jump into the economic reports. We'll start with the housing starts for the month of February. So these are adjusted annual units, and back in January it was at 1.58 million annualized units. However, that was revised slightly higher to 1.584. Forecast for February was supposed to dip slightly down to 1.56, and it dipped down much further to 1.421. Now, we also got future housing starts with building permits, and back in January it was at 1.886 million adjusted annualized units. And forecast was supposed to slow down a little bit to 1.75, and it slowed down even further to 1.682. What's kind of bringing this upon? Yesterday we did see the confidence level for home builders dip yesterday, and for March it dropped 2 points from 84 to 82. Now, a lot of this has to do with rising costs. Lumber went up over 200% for them. Now, with these costs and where the prices are at, they could pass some of the costs over to the consumer. However, it may kind of put things out of range, and you may see consumers walking away from that. So, even though we need a lot more housing, if you look at, for example, the amount of listings, we see listings dramatically lower than what we saw even last year. And each year we've seen a tighter and tighter supply level. And just California alone, there's a car came out with the report yesterday. It dropped 53% from year over year, and that's quite a big drop. Now, we can even touch a little bit on this here. These are mortgage applications that we get out, but that the MBA sends out each week. And there was a slight uptick in terms of purchases. However, refinance due to higher rates have declined a little bit. Now, later today, as we mentioned before, the Fed will be be wrapping up their their two-day meeting with the FOMC. Now, we're not expecting any change in terms of the rates. It should remain at 1/8, basically, percent. Now, let's jump over to the headline news. We'll touch on that, see what's going on. And mixed stocks are mixed. They are at Dow, I believe, is the only one that's actually in positive territory. Now, what's bracing it is this FOMC announcement. There's a lot of things that are going into it. This is going to be an important one because we're seeing a huge spike in yields again today, which we'll touch on in a bit. We're seeing a big spike. And of course, stocks are getting worried. The high-tech sector is being adversely affected due to the higher yields, which creates higher borrowing costs for them. And so these are different factors. Now, the investors are going to be looking for this coming announcement. They're going to be looking at approximately the dot plot. December's dot plot basically showed them not raising rates until 2024. However, with the stimulus package now signed into law and projections of the economy may be heating up, they may move that up. So they're going to be looking for that. There's also another thing in there that it's called the SLR that the Fed put into place last year around April. Now, what this is, I won't get into the whole details, but basically it's a ratio that the lenders need between their lending practices and their debt, like treasuries and bonds, the ratio that they have to hold and as to what they can lend out. They basically waived that, and they're hoping that the Fed will extend that. So, and hopefully touch on that in their meeting today. It's possible they could touch on it later, but if we can get that extended, they're expected to extend it, but it's not a guarantee. If they get that extended, we could see a rally in yields, which will help us out a little bit. If not, it could go the opposite direction, and we could see a much greater spike in yields. So again, this is something that will be important coming up from the Fed once they make decisions. So watch for those items here. Now, this will be coming up in probably a couple more hours, about 2 more hours. I'm doing this report about 2 hours prior to the Fed announcement, which is approximately 2 o'clock East Coast time, 11 o'clock here on the West Coast. Let's go into take a look, see what's going on with mortgage rates today, and they are not looking as good. They have dropped down 22 basis points from where we left off yesterday, and that is, of course, not good for mortgage rates. So mortgage rates did increase a little bit as a result of this. However, depending on their bracing for the Fed. So if the Fed can address concerns about the yields and the investors like it, that might help out mortgage-backed securities in the short term. Also yields, which we'll touch on here as well. As you can see here, we jumped all the way up to 1.67. We jumped up this next level here. So the next level here might be at 1.75. The next level above that will be right around 1.95. So we're back to just above levels that we were at before the pandemic. Around February, we were right around of last year. We were at these levels. So this kind of tells you where we are in terms of where yields are at in terms of the timeline of where things were at. So we're getting back to pre-pandemic levels in terms of yields. So again, rates unfortunately did go up a little bit, but we may see it get worse, or we may see it improve depending on what the Fed came out and what we had discussed about and we listed what to watch out for, what investors are looking for. So stay tuned. You guys have a great rest of your day. Thanks so much for watching. We'll see you in tomorrow's video. Bye-bye.